I have Mr. Chris Recker with me in studio from AZA Capital Management, Chief Investment Officer. Chris, great to see you again.
Good to see you, Oliver.
Yeah, it's been a little bit.
It has been January.
Yeah, so the market obviously kind of taking this little tech tailspin in the middle of the rotation, but there's this kind of silver lining to it where it's like, you know, okay, S&Ps are down over the last 2 weeks, but all this other stuff seems to be saying the economy is like on a rosy path right now. Are you buying that?
Well, yeah, I think we would definitely say we're in a Goldilocks period right now, and this is, you have 2%-ish growth, moderating inflation. You have a market that seems healthy. Financial conditions are easy in the markets with tight spreads, healthy equities, and then where things are a little bit tougher, you're seeing cracks in where financial conditions are tight for people on Main Street. Mm-hmm. So that's what we see.
Some of that stuff seems to be immigration related. Some of the unemployment rise. That's an argument I've heard that I feel like is a decent explanation. What do you think about that? Basically, people saying you got so many people coming in here, they're looking for jobs. That's going to make unemployment go up, but it's not going to actually drag down like productivity in the economy. Do you find that to be true?
I'm not very convinced about the immigration argument. I'm not a big buyer of it. I think this is just a normal cycle in the economy. What we see is the cyclical components of employment, temporary services have been, taking a nosedive for several months now. And so what you see is with this manufacturing kind of slowdown or recession we've had for years, for 18 months at least, you see basically companies pull back on temp help. They pull back, full-time jobs are down, but part-time jobs are up. So everybody's cutting hours. Everybody's waiting to see what the next leg looks like. And if we're going to work through this period of basically a price jump, everybody's wages are catching up to the prices. And so that is really the question I think for the economy is going to have to answer. And I think the markets will sniff out at some point whether or not the economy is going to really slow down. I think right now you look at credit growth, it's all kind of back to where we were in the mid-2010s and teens, and that's kind of, if it breaks lower or higher, that's the real question, and that we'll have to wait and see.
That's kind of where we're in this tough spot where, you get a week like this, GDP comes in better than expected, the jobless claims kind of hit the average, inflation continues to kind of disinflate, but then we're still positive month over month too, so these nominal levels are elevated, but the market's so convinced that all of this adds up to not just a cut by the Fed, but the beginning of a cut cycle. We've played this game for 18 months. It's like this time they're saying it's absolute, basically, the conviction, because we never had the breakout in the Russell. We never had the rip in the regional banks. The market's basically saying this time is different. We're really turning the corner here. Does a couple cuts really fix all the underlying issues?
I don't think they fix the issues. I think the real question is, and look, that's right. Back in May 2023, the market priced 6 cuts. January, last time I was here, the market was pricing 6 cuts.
Yep.
We're going into August, it's pricing 2.5 cuts by the end of the year. So I think we'll get cuts this time. I do think the market action you just described is very important. I do think that there is, this relative value trade going on. And this, where you talk about the small caps, you talk about value, some of these left behind sectors. That is, I think we'll have to wait and see. I think there are a lot of doubters about this trade.
Sure.
And I think we're leaning toward it's more real. And I think the bond market, the long end of the bond market, and basically the steepening or the bull steepening that we've seen recently is kind of the sign that we are going to see cuts and where inflation's at.
To your point about just kind of being a run-of-the-mill cycle, though, that bull steepening is usually when the recession's like about to hit, the uninversion actually.
Right.
So does the small cap trade work through all of that, or does it work until, and then you get back in on the kind of upswing for the economy?
I think that's the real question. I'm in the latter camps right now. You call me a little bit. I would say what's different about this than what we had 25 years ago was that back then small caps were a much higher quality index as far as earnings go and valuation. But the valuation spread today is just as wide.
Right.
But
quality's not as good.
The quality of earnings is not there. But when you look at floating rate debt as a percentage of debt for the small caps, it's about 50% of their debt. Whereas if you look at the large caps, 90% of their debt's fixed. So they
That's
are going to be
interesting.
more interest rate sensitive. So if you go into a serious rate cutting cycle,
Yeah.
their earnings may have some pressure coming off earnings going into what could be a recession. And there's always the liquidity factor we're just not aware of. And so maybe because they've lagged this time, the sell-off may not be as hard for small caps as we've seen in the past. But the stuff that we look at hasn't told us really to step in hard into small caps. We've been buying it in certain places for people, but it's always hedged or in some kind of a pair.
It almost kind of sounds like, if I were to try and kind of simpleton a little bit, then maybe it's like, okay, you get into the small caps now because even if we have to cut for bad reasons, the economy's going to slow down, the math is so much more responsive to their style of debt that even maybe in a down market, you'll get the small caps outperforming in a down market. And that is kind of what we've been getting here, basically, because technically we have been getting a down market throughout all this.
Right. And so maybe that is your tell that this rate cut cycle is real.
Yeah.
But the small caps are one of the canaries that will tell you what's happening.
To try and get an idea real quick about maybe how much tech has to correct, you've got a good chart here looking at a valuation metric. This is your guys' kind of custom way to look at price to sales, margin adjusted. Well, this is just for the info tech. What are we looking at here?
So back in the tech bubble in 2000, I would say the NASDAQ and the S&P were trading 30 to 40 or more times earnings. The quality of earnings in the tech sector was very, very low, whereas today I would say it's very high. And so the tech sector has profit margins much, much higher. So we're like, more profitable companies, you should pay more for these companies.
Exactly.
And so what we said is, okay, based on profitability today, for X percent of margin, I get X, I should pay X.
Oh, wow.
Some multiple of sales.
This is a really fair, this is like a generous way almost.
Actually, this is the opposite of a reversion measure where I'm doing, this is the opposite of a cyclically adjusted measure. It is a pro-cyclical measure to say, if net margins are 22% today, let's say this sector is maybe selling close to 10 times earnings. What we're saying is, this is deviating from that level we think is fair value for this level of profitability. If you have a recession, earnings will go down likely.
Right.
So this is not, so what we're saying here is, even if you're more profitable, the valuation relative today where you should be for a given set of earnings is still extreme.
Wow,
so
that's pretty interesting.
Expectations are very high.
That's a really interesting way to frame it, because a lot of people, if you look at the price of sales, they go, oh, we can't use that anymore because these are more profitable companies. You're basically saying, all right, well, then let's just clear the slate on that too, and zero the scale kind of even more in favor of giving the companies the benefit of the doubt, but they still look very expensive.
That's right.
S&P is bad, or is because of that other 493, does it look cheaper, a little bit more reasonable?
What we like about the S&P this is the first time in a long time I think we've seen a lot of really good companies have problems. So whether it's Disney or Nike or Starbucks, those types of names, even an AGCO, those are all, you can go back and I think that there's an opportunity here for a lot of pair trading or a lot of relative value trades. And so we've been encouraging is looking at, people want to look, if you're at a hedge fund or you're doing your own trading, look at relative value trading, look at options. Options are very good ways to express these spreads. And so that's where we've been kind of deploying capital over the last several months, and that's kind of what we like.
And it's on index level?
I would do the options on the index, and I would look at names, or you can do indexes. We've done both. We've done indexes, and we're trying to play cycle with certain, the spreads in the bond market are really interesting too, because junk is a little bit higher quality. Again, there's been a lot of quality changes over the last couple decades in all of these different sectors of the market. So your junk part of the market, or high yield, is probably a little bit higher quality, so the spreads are tighter. So maybe, we've been pairing shorter term, high yield, small caps, value, some of these fallen angels with index type options.
Okay.
So those are more bespoke applications, but if you were looking for places to investigate as somebody, that's where we would recommend.
Love that. Love the specifics. And then the index level option, you're hedging by what, selling upside, or just putting like a collar on? Or
we'll just go buy puts, sometimes out of the money puts on XLK, on the Qs, or S&P. Sometimes we do systematic strategies where we hedge. We're always hedged.
You're basically full in on the rotation concept, essentially.
We like it. We think we haven't gone full in. I would say our firm will probably, our models will probably be more in the bond market over the next 6 to 12 months. And then if we get more opportunities, we'll
More of that
move
kind
up
of
in
washout.
equities.
Yeah, love it. Really good stuff, Chris Recker. Great conversation.
All right, thanks, Oliver.
Love to get in your mind and figure out how you're looking at the data in the market. Love the evaluation chart as well. Like the strategy too. Okay, leaning into the rotation, not fully going there, but the idea that small caps could outperform in a down market should be resonating after the last 2 weeks. Thanks, Chris Recker, AZA Capital Management.